Hello and welcome to Copytraders Club, where you can learn how to make more money copy trading. I am Gavin Macaulay, my name and username on eToro. Like you, I copy trade, and together we can learn from others how to do it better and have some fun. Here we go! Welcome to episode 6 of Copytraders Club, and this is one I've been looking forward to for some time. They don't use the term rising star on eToro anymore, but it describes today's guest well. None other than Robert Reynolds, aka Robert MERC. He is one of my PIs. So I can't wait to chat to him today at the clubhouse. He's already out of the limo and dancing merrily up the steps. I better go greet him. Robert, hello.
Hi, Gavin. Thanks for having me.
Oh, well, it's great to have you, in fact. I can't wait to get chatting. But before we can, you as a guest have to be signed in at reception, okay? So that's done by answering a series of quickfire questions. You ready?
Absolutely.
Username on eToro?
Robert MERC.
Date you joined eToro?
I joined on the 15th of March and first trade was on the 17th of March 2020, last year.
Year of birth?
91.
Marital status?
Married.
Kids?
2.
Location?
Basque Country, north of Spain.
Profession?
Professional money maker, put it that way. Investor. I'm an investor across entrepreneurship and public markets.
Name one of your investing heroes.
Oof. If I have to pick one, it would probably be Rich Dennis.
Name one of your favorite investing books.
Favorite investing, probably the most eye-opening book I read was Ralph and Elliott's book, The Principles of Elliott Wave, for the simple fact that it was so eye-opening to me when I first read it, coming from a fundamental background, to read this sort of theory that seems like voodoo magic, but seems to be quite consistent. So I'd definitely say that that's probably up there with one of the best eye-opening books that I've read.
That completes the formalities. Let's now proceed into our VIP section here at the clubhouse. We're going to walk over the marble floors, past the charming fountain, and into the splendid Copytraders lounge. So, Robert MERC, are you ready for this magical transition?
Absolutely. Let's roll.
Here we are now in the fabulous and ornate VIP lounge with spectacular views off into the distant countryside. Who'd have thought that a couple of wee fellas from Ireland would end up in such a fancy environment, eh, Robert?
Absolutely. I mean, I never thought I'd be in such lavish surroundings in my life, but look, we made it. We made it to the top.
We did indeed. So where are you from in Ireland?
Dublin. And you know, it's really interesting because, as you probably know, it's Dublin and then it's the rest of the country, and the rest of the country hate Dubs and the Dubs hate the rest of the country. It's kind of a funny kind of battle, but yeah, unfortunately I'm a Dub for the rest of Ireland, who are from the bog, as they say.
Lovely. What part of Dublin are you from?
I grew up in the south side of Dublin. So I grew up in around Dublin 18, but when I grew up there, it was just fields. And that was it was just a lot of fun. There was nothing really there. But as I got older, I moved into the city and I lived in around Dublin 7, Dublin 8, and around that region. So got a bit of both worlds, inner city Dublin and also more of the outskirts.
Okay, cool. I've got a sister who lives in Sutton.
Oh yeah, that's up further north, eh?
Yeah, it's a lovely part of Dublin.
Yeah. Yeah, you have Sutton. There's a big long beach in Sutton, which is beautiful when the weather's shining. That's where everyone flocks to. And then you've got like Dunleary, Killiney, and around that area. Yeah, and outside of there, you don't really have too much, on offer. But yeah, no, it's a beautiful place up around.
It's a dirty old town.
It's a dirty old town. There you go.
All right, so let's not think too long about the old country.
Yeah.
In case we shed a tear.
Absolutely.
Far across the foam. Let's talk about you. Okay, so I was researching you through many of your videos. Let's talk about your backstory. You've always been an investor since learning your cousin's husband had a portfolio, and that didn't mean he was a photographer.
Yeah. Yeah, that's kind of a funny one. I mean, I've like always had this urge for materialistic things. And, I'll tell you when it first started, very young, driving past the Shelburne Hotel, and there's a red Ferrari outside the door. And my mom said to me, "Oh, you'll never be able to afford one of those." I don't know. It's just an urge. You grow up like not having anything. You want an awful lot. And it wasn't that like, it's not necessarily that I said, you know what, I'm going to be a portfolio manager and I'm going to make tons of money. It was more so whatever job paid the highest amount of money, that's what I was doing. And I didn't care whether I liked it or whether I didn't. It started off that I was going to be a bank manager, and then it was going to be an accountant. And then my mom said to me, your cousin's husband, my cousin actually worked for Merrill Lynch. She was already a banker, and she married a portfolio manager who was obviously doing an awful lot better. And that's when I was like, what's this portfolio management thing all about? And that's really what sort of caught my attention. It's not, I never grew up saying I'm going to be an investor. I'm going to do this. I'm going to do that. I just wanted the money. That was it, to be very blunt. But when I started to do it, I actually really enjoyed it. I've got a very competitive sort of personality, and it's definitely a competitive landscape with yourself and with, in my view, now that I'm on eToro anyway, I like to compete with some of the other PIs and keep my risk low and keep the volatility in the portfolio low while outperforming them. And I'm pounding the table at certain times, and I mourn the losses at other times. But yeah, no, I'm really enjoying it. It's something that kind of was by a little bit of an accident, but I'm pretty grateful that I went down that route at the same time.
Yeah, and did you go down that route like straight after university? You started working with your cousin's husband, or?
No. He lives in New York, and so I would communicate via phone, and even up until this day, he's a fantastic support for me. I went to university, and I initially studied business studies, and I hated it. And there was 2 months before I finished all my assignments. It's my very last year. 2 months before I was to finish business studies, I got a visa to go to Canada, and I took the visa and I didn't hand in my paperwork. So to this day, I still have those assignments that I probably should have handed in. And then when I came back from Canada, I studied accounting. And so when I came out of that, I had all this education, but I never applied it to anything. I got a little bit lucky, met a girl. I was pretty broke at that time. She had a little bit of savings. We realized that the real estate markets were quite, they were quite cheap to buy real estate. The cash flow yield that you would receive on a property was quite high. So we started considering buying real estate. At this time, I was already investing, but only a very modest amount, very small amount. And we just got very lucky. Got involved in real estate at the right time. And over a couple of years, it ended up appreciating quite significantly. And I didn't have to work for anyone else if I was frugal. And so we moved to Spain. And one of the reasons why we moved to Spain was because the cost of living here is about 1/3 what it is in Ireland. So that was one of the main reasons why I left Ireland, was to make the dollars that I made last a little bit longer, give me enough time to learn my craft, and also continue to compound that money. And that was one of the main reasons why we moved to Spain. And obviously we've built our life here. We've got kids here now. So it's been an eventful journey, but I've never had a 9 to 5. I've just been hustling myself, if you will.
Yeah, that's awesome. And you're in, you say you're in Spain, but specifically you're in the País Vasco.
Yeah, they speak Euskera here. Different culture. People here are very straight, very honest. When I say honest, I mean if they don't like something, they're very quick to tell you. And I think that's a really good trait to have, because you never find yourself, certainly in investing, I spend a bunch of time analyzing a company. If I don't have the confidence to not necessarily confront somebody, but reach out to somebody and discuss a counter argument, I'm not going to be able to come with a holistic view of a specific investment idea. And so in the Basque Country, they're very direct here. And over the past couple of years, I've become a little bit more blunt, and I'm a little bit more open to the sort of opposite arguments of different investments. And so, yeah, it's definitely, there's been some positives, and then there's some negatives. I'm away from home as well, but it's kind of a similar culture here too. Even though the language is completely different, it's not Spanish. It's very different to Spanish. It's more like Arabic or something like that. It's very different, very difficult to learn. And although that's a challenge, people here are still quite similar to Irish.
Sure. And Bilbao is the big city in the
You have
Basque Country, right?
Bilbao, you have San Sebastian, you have Vitoria-Gasteiz. Yeah, there's a couple of big cities. I mean, the population in the north is 2 million. I'm living in Bilbao, so
You're in Bilbao itself.
yeah.
And have you been to check out Athletic Bilbao?
I have. My wife has just randomly become a super fan out of nowhere. So she
All right.
wants season tickets. She wants this, that, and the other. She wants jerseys for it. We've got 2 little pugs. The pugs are like children as well. So she's got jerseys for the pugs. She's got flags all out of nowhere. It's like just a random midlife sort of event that she's having where she's become a football super fan. So
Yeah, you see, this is the kind of detail people are going to flock to Copytraders Club for. The fact that Robert has 2 pugs dressed in
Yeah,
Athletic
super
Bilbao
fans. Yeah.
strips. Quality. All right, so let's talk about how I came across you. You listened to the previous episode that I recorded with Karan. He's the guy who brought me to eToro. My plan was basically just to come and copy him. I wasn't necessarily going to play the eToro game and have thousands of PIs. I was just delighted to be able to copy him. But I had also been on your YouTube channel when I was researching Dropbox as an investment for myself independently. And I was I was quite far down the line with Dropbox. And I liken it to sort of somebody being on the high diving board, peering over at the swimming pool. And then Robert comes up and gives me a big kick and sends me flying into the water. Your videos are just stunning in their impact, you know. You talk through every aspect of Dropbox. And the things that I kind of thought, you hammered them home. And the concerns I had, you addressed those. And honestly, by the end of that video, I was thinking, well, that's my research complete. It wasn't the first time I thought about Dropbox. I'd done a fair amount of work by then. But we'll come on to another couple of your videos that made an impact on me, more so than that. Now, having watched your Dropbox video, I then clicked to see, who is this guy? This guy's Irish. He's talking about Dropbox. I'm interested in Dropbox. He's far better at this stuff than I am. What's he all about? And your pinned video, if that's what it's called on YouTube, is your personal story one, right? Why I started my YouTube channel. So I watched that, and then I was instantly thinking, oh, this guy's the real deal. He's looking down the barrel of a camera. He's telling his truth, as the Americans say. And in that video, you state how all YouTubers have an agenda, and you're no different. Your aim is to build up an audience so that audience can help you when you come to launch your passion project, which is aimed at helping people stop smoking. So I wanted to know, can you give us a bit more on that? Where are you in that business? And can you tell us more about what it is?
So my parents smoke, my brothers smoke, a lot of people in my family smoke, and it's just something that's been on my mind for a long period of time. And then over time, you start to meet more and more developers. You start to figure out what's possible. I met people inside Big Tobacco. They're telling me what their developments are internally. And in 2018, I met a group of people that I said, look, I think we'll be able to create something that'll be more effective than what's already available to help people to quit smoking. And in a part, it started out as like a sort of philanthropic type event where I didn't really care about the returns. I didn't care about the business. I just wanted a product to be built. And in doing that, I made a big mistake because I spent a lot of money. I wasted a lot of money because I wasn't thinking it as sort of a business. And then essentially what the product we came up with was it's leveraging big data and behavioral sciences. So we're collecting specific behavioral data from an end user. So the time of day that they smoke is very much habitual. So a smoker might have a cigarette right after their breakfast, and that would be very consistent. So Monday to Friday, if they're working 9 to 5, after the breakfast, usually around the same time, a little bit after, what we've come to realize is that somebody would have a cigarette in and around the same time every single day based on their habits. And if we could recognize those habits, we'd be able to deliver a critical message at the right moment to discourage them from having a cigarette. So that was one element of it. So that could be based on health, right? So depending on what your reasons to smoke are, it could be based on health, like so the effects it would be having on your health. So each cigarette, you'd lose about 16 minutes of your life. And so we might remind you of that. It might be savings goal. So if you look in Ireland, about €2,700 per year is spent on cigarettes. And so if you're looking to save some money, we'd be able to remind you of your goals. And that might be enough to trigger a response to maybe have one cigarette left. And the idea would be to reduce the number of cigarettes over time to a point where the dependency on nicotine is diminished enough where the user would have a really good probability of going cold turkey. So taking 20 cigarettes a day down to 3 or 4 and then going to 0. And what we realized is that gamification is a good way to replace the chemical balances that happens in your head when you have a cigarette. So when you have a cigarette, the nicotine causes this kind of 1 second lightheadedness. And so when you're stressed out, that one moment of, subconsciousness is enough to give somebody a little bit of relief. And that might be true, maybe working too hard or something like that. And every time they get to that point where they're working really hard, they crave a cigarette. So what we decided to do is to replace that sort of chemical reaction in the brain using gamification. So we've got one side of it, which would be big data and delivering critical messages. The other side of it's gamification. So there might be a group of people and there would be like a pass it on challenge. And the pass it on challenge would be if I have a cigarette in the morning, only after I have it, the next person could have it. So you could have a group of 4 people. And after the first person has a cigarette, then the next person and the next person and so on. And as long as we could ensure sort of user integrity so that people aren't like cheating, we'd be able to create this sort of fun gamification where there's a messaging platform where they could go back and forth and message each other, say, come on, I need my cigarette and whatnot. And so what we decided to do is build out a hardware initially. And the hardware would have just a simple gyroscope and an accelerometer measuring the micro movements of the wrist. So every time the wrist moves, we could build an algorithm and we could detect when you're having a cigarette. And so that would give us indication as to when somebody's having a cigarette. But we could also determine when the watch or the wristband or whatever it is taken off the wrist. So we could ensure compliance. So when we're doing the gamification, if somebody took the watch off, we'd send a notification and let everybody know, hey, listen, this person is just taking their watch off. They're not complying with the rules of the game. And it would be like community sentiments, peer pressure in order to reduce the consumption. And the idea is that we would create this gamification that's exciting for the end user in order to force a reduction in smoking. And so that's just one example of the gamification, but they're the 2 elements that we believe will be a healthier and safer way to quit smoking. So that's essentially what we're focused on.
Well, that's a tremendous explanation. Thanks for that. Gamification is the pronunciation of that, turning into a game.
So you look at an awful lot of the criticisms of Robinhood's application right now is that they've gamified the process of trading.
Yeah, Robinhood.
Yeah, exactly. Out the window. But they've gamified the process and it encourages people to trade a lot more frequent.
Yeah, and no other platforms like that do such a thing. Only Robinhood. My only concern with that is I, for one, wouldn't want any sort of monitor on my wrist that shows my wrist activity throughout the day, because you might be gathering all sorts of data which is nothing to do with smoking.
Yeah, well, the only data you can really track would be motion. So we could track.
Well, exactly. That's my concern.
Like that.
If my wrist is in swift repetitive motion for 5 minutes.
I see. Yeah,
That's the kind of data I don't want anybody else to have.
Yeah. No. I think I'm pretty sure we don't want that data.
Well, there'd probably be a cigarette after that for a lot of people. So maybe that's a forerunner to a moment of weakness.
Well, it's important to note that it'll trigger when the axis moves on an accelerometer, it'll trigger this specific motion. So it's not active all the time. There'll be a specific rotation that will trigger it. So don't worry about that.
Right, let's move it on now, Robert, and have a little look at your bio, shall we?
Absolutely.
Would you like to maybe just read your bio for the benefit of the listener?
Yeah, absolutely. So my strategy is primarily long biased, using hedging strategies to move market risk and or sector risk caused by higher volatility. Portfolio manager first and foremost, during times of higher volatility, the cash balance will be increased significantly to offset risk to capital. Timeframes on positions are typically 12 to 18 months outside of high volatility. On occasion where the risk to reward is in our favor, I'll add to the position over a shorter period of time to take advantage of a clear technical setup. Copy open trades. From time to time, I will short the market or specific sectors to offset volatility. This is not to make a return, but to smooth out the returns curve. My approach is as follows. Number 1, macro top-down appraisal of credit markets. Number 2, forecast potential GDP swings via soft data and fundamental bottom-up analysis of companies on my watch list. Number 3, technical analysis. And number 4, risk management. That is my bio.
There's a lot of words there. We will get into that later on. And you don't have a pinned post that kind of expands on your bio, but a quick look at your posts and you can see that there's all number of YouTube videos there.
Mm-hmm.
Monthly updates and more specific ones, which is one of the things that sets you apart from many PIs, your YouTube channel. We'll get into that later as well. Let's just quickly run through your stats. You've just completed a year.
Yep.
And your annual return for 2020 starting in March, the total quoted here is 35.29. And after 2.5 months of 2021, at the time of recording, you're currently at 21.60. So that's a magnificent start to this year and a very healthy last year. So it's looking good. Copier numbers have been going through the roof.
Yeah, I've been lucky.
I think that's what happens is I'm like a talent scout. I spot a couple of PIs, start copying them, and then just word must get out, even before the podcast.
Absolutely. Absolutely. You're like the Messiah.
Like I was number 16, I think, with Karan. With you, I don't know what it was, 100 and something maybe?
You were quite early. I mean, I did have like about 15 or 20 people before anybody. They were friends and family. So,
yeah.
But no, you were very early. I remember you reached out to me initially and we had a conversation back and forth on the platform.
So now you're up to 1,450, 1,450. That is meteoric rise.
Yeah.
Got to be happy with that.
Even more so, like I'm only a year on the platform, and no matter what, I know I have a YouTube channel, I know I explain my ideas, and I know people can build confidence that way, but I don't have a public track record more than 12 months. So I'm extremely grateful that people, take a leap of faith and trust that I'll be able to allocate their capital, and so, yeah, I mean, I'm definitely humbled by it for sure. It's a lot of people.
Well, we'll get into that, what you just mentioned there about people trusting you, the track record. Not everyone has the same view on whether a track record is the most important thing, particularly on eToro, particularly given the holes in the stats. So let's look at your portfolio. Yeah, there's a couple of topics I really wanted to talk to you about. One is Manish Pabrai has been talking recently about a shift in his investing where he's looking for spawners. Are you aware of how he talks about spawners?
I'm not sure what a spawner is, no.
Well, he's looking for a company that has it within its DNA to create or nurture other businesses within their business.
Okay, yeah.
I was wondering, is that something that you look out for, or are you particularly excited when you see it? For example, Dropbox and Overstock, they could be said to be spawners.
Yeah, you could say Facebook with Oculus as well. It's not something I specifically look for. I'm more like a very dogged investor where I just want to find some sort of value I can clutch to that'll give me conviction. Dropbox falls into that category. Overstock falls into that category. You could say Facebook and Oculus fall into that category. And when I find it, it absolutely gives me an awful lot more conviction because if you think about it, if these internal businesses, certainly for Overstock, were to be spun out in a couple of years, it could equal or maybe be greater than the size of the current market cap of Overstock's current online business. And that's the conviction that I have where in the near term, anything can happen. But in the long term, I feel like there's a high probability that I'll be right.
Overstock is a furniture company that's trying to do better selling furniture online. But it's also got magic underneath its umbrella. So tell us about that.
Okay, so Overstock it's an online retailer, and we're moving into, from a macro perspective, we're seeing millennials come of age and they're starting to buy single family homes. So you're seeing in the United States, the supply of homes right now is really low. That's largely driven by demand. These people are going to be buying furniture. So right away, from a macro perspective, that business should do very well, the online retailing business. And then internally on that, they've got what's known as Medici Ventures. Previous CEO was fascinated by digital assets. He set up a whole portfolio of different digital assets, allocated a bunch of money, but it was very poorly managed. The whole company was poorly managed. There was no focus on the furniture business. There was no focus on these digital broker platforms and voting platforms. And it was a little bit of a mess. The value proposition for Overstock today is that we've now seen Pelion Ventures come in. They're fully capitalized. They're taking over the digital side of the business. When you break it all down and you see the cash that's in the business, plus the cash that the online retail business is delivering, the fair value for that business is around $54 per share. And when we started to buy it, it was around 61. And I was betting that in Medici Ventures, it was worth an awful lot more than $6 per share, far more than $6 per share. And so internally, you have this opportunity where over the next couple of years, with enough capital, Medici Ventures swells up to a business that could be equal or bigger than Overstock itself. It's spun out, and we, the shareholders, will get an equal number of shares in that business as well.
Yeah, I saw a really interesting YouTube video today, or listened to it earlier when I was in the car, entitled "Why Overstock May Reach 200" by Stock Talk with Eli, PhD. You familiar with this guy?
No, but I probably agree.
He's mad into Overstock, and he has a very deep understanding of T0 and blockchain technology, and he makes loads of videos on all this stuff. He thinks T0 is a revolutionary company for the financial markets, applying blockchain technology, getting rid of all the middlemen and increasing efficiency. Now, what he says is they plan to take all three areas of public securities, private securities that aren't currently liquid, and cryptocurrencies and asset-backed tokens, and be the place for them all to be traded, which is totally revolutionary. So his point is that comparing it to Coinbase doesn't do justice to what T0 could become, because Coinbase is just one of those things.
Possibly.
It's one part of the Venn diagram, and T0 is right in the middle. So he talks about how everything can be tokenized in the future, including real estate, fine art, and all these previously illiquid assets. You can buy tokens in that Picasso you've got hanging on the wall behind you there in Spain. And if that increases in value, so do my tokens that I've bought.
Yeah.
So, and he's trying to get the CEO of T0 on for an interview. And he also tweets about Overstock news all the time. It's at Talk with Eli. I'll put it in the show notes.
Yeah.
You might want to check it out because, I mean, he's really focused on all that stuff.
Yeah.
That's pretty interesting.
Well, yeah, I mean, with T0, the really exciting part about it is they've just got the FINRA license. They've got a clearinghouse. This has all happened really recent. So over the next couple of quarters, we'll see if his analysis or his prognosis is going to be correct. The way I look at it is I would always compare it to something like Coinbase because they've had a meteoric rise. They're IPOing at $95 to $100 billion after 8 years. So, Overstock right now is an enterprise value of $2.8 billion. If over the next 8 years they achieved anything even remotely close to Coinbase, I mean, it's a 30, 40, 50x return. And so if it's bigger than that, excellent. It's still in its infancy. And I think over the next couple of quarters, as we get more and more information on the adoption rate and the execution, I think it'll be very interesting. I hope he's right. I really do. But I 100% agree with him that $200 per share is probably fair. Considering he's thinking that it's bigger than Coinbase, $200 per share is quite low.
He's a mega bull, obviously.
Yeah.
I mean, he thinks it's going to take over the world, this thing, and it's going to be a household name and all the rest of it. Let's get back to talking about your portfolio. And one thing I wanted to talk about is how you'd like to hedge out market risk, right? And until recently, you were shorting the S&P 500. I thought that was going to be an ever-present in your portfolio, but it seems to have been replaced now by your position in TLT.
Yeah.
Tell us a bit about that.
I got a little bit more concerned regarding the level of inflation that we might see in 2021. And essentially, the reason why you hedge out market risk is if you have some concerns from a macro level. Let's imagine that an airplane flew into the World Trade Center and then you've got the markets closed for a week and then it reopens down 10%. You would offset market risk by shorting not necessarily an equal amount of the index, but some portion of the index to offset that volatility. As inflation starts to push higher and your real returns go below zero, you're no longer competing with sort of bonds in a sense. You're competing with sort of the return on assets. And the best return on assets in that environment is equities, but more specifically, different types of inflation hedge assets. So as of right now, while we have higher inflation, I think it's better to have our money parked in a diversified basket of fairly valued companies.
I'm glad you mentioned diversification. It's a point you raise quite a lot. We're in a diversified portfolio. What I'm wondering is, Robert, you're diversified in terms of asset classes. Fair enough. You don't have an enormous number of positions. Some people think the more the merrier when it comes to diversification. You know, you see PIs with 120 different stocks. You're always telling people, don't worry about it. It's part of a diversified portfolio. If something goes down, it's not a great concern. I wonder when I hear you say that, is the truth more, you don't worry about it because you know what you own and you have the bandwidth to know everything there is to know to stay on top of your 28 companies. But you're saying the thing about diversification more for the copiers because it's easier for them to get their heads around, oh, it's part of a diversified portfolio, therefore I'm not going to be worried.
Well, I'd never buy something that I didn't own first and foremost. And when it comes to diversification, 28 positions might be a lot for some other people. I think 50, 100 positions is way too much. And I think what that's basically suggesting is whoever the investor is doesn't have conviction in any of those positions. And so for me, if you look through the portfolio, I've got some positions as high as 7% allocation, and I've got some positions that are down around 1 to 2%. And what I mean by diversification is it's not to reduce the returns in the portfolio, it's more so to diversify the risk.
I can't believe we've spoken this long without getting into what MERC stands for.
Yeah.
And no, there's a lot of words in that answer which might go in one ear and out the other. So I'm going to start by explaining what the experience is like of watching one of your YouTube videos.
Okay.
To me, it's like being on Google Maps, you know, when you zoom out completely and you're looking at the world, right? That's where you start, is looking at the world. There's the whole world. And then you start zooming in into a continent, into a country. And before you know it, you're on a street looking at a scratch on the gate of the house that Robert grew up in. You know, it's a total immersive experience from way out here to way in there. You start off looking at how the world is, and you end up with your charts and Elliott wave and using all these terms I don't understand, just trying to find the perfect entry point. That's a simplistic picture of what it feels like. Now I'm going to let you loose on describing what MERC means.
Yeah, I mean, it's just a very basic acronym that explains exactly what you just mentioned. So M is like macro top down. So my view on the world is credit drives everything. And if you have higher liquidity, asset prices are going to go up indiscriminately. So you'll see stocks go up just like you'll see, real estate market go up. And the reason being is if credit gets cheaper, hedge funds can leverage, but also homeowners can leverage as well. They could borrow more money and drive up real estate markets. So if we have ample liquidity in the world, that will generally lead to risk assets increasing, right? So the first part of it is M, macro top down. E is economic appraisal. So I generally invest in the United States. It's the most liquid and it's got the most consistent data. So I'll look at the economy, I'll look at manufacturing and services, I'll break down the 18 industries in both sections, and I'll figure out which one's performing and which one isn't. And that helps identify different sectors that are performing, but it also helps me identify what performs early when liquidity starts to increase. So which sectors I should be invested in early to maximize returns. And as we get mature into that cycle, where should I be allocating my capital or rotating it to maximize returns? So the economic appraisal part is really good for sort of back testing and really understanding what drives asset prices and when. And it also gives me a perspective on how the economy is currently running. And then we get into OR, which is risk management, which is usually at the end. You look at your charts first, you determine, okay, I've done a bottom-up analysis of this company. The macro top-down lines up, the economic appraisal, the economy looks quite strong. And then I'm looking at the charts. The chart now stacks up. All my ducks are in a row. So normally you would have charts instead of OR, but it doesn't sound right. But I'd have the charts in there, and then finally risk management. And risk management's really about diversification and position weighting. And a part of that's got to do with charting as well, and timing and valuations and all that. They kind of all mingle. So that's essentially the process. Macro top down. Then you have economic appraisal and bottom up analysis of the company, risk management, charting. And yeah, I use that acronym because I think far few people actually have a holistic approach. Not because they don't know what they're doing, but I guess it's more convenience to avoid one or two of those steps that are kind of frustrating. And that's a discipline that I kind of learned it from my football coach growing up. He was, I hated his training sessions, but we were a really good team. And when we go training session, I'll give you an example. We weren't allowed to take a shot at the goal. We had to pass the ball into the goal. We had to get good at passing the ball into the goal. Hated it. Just wanted to hit the ball as hard as I could, score a goal like Cristiano Ronaldo, and just do a cartwheel. That's all I wanted to do. And I would love that if I could do that in training every week. But instead, we would have to have a very physical training, and we'd have to pass the ball into the net and make sure that we got it on target first. And then we'd pick up our pace and we'd hit it a little bit harder. And it was boring. It was like, he was my Mr. Miyagi, if you will. But after time, you realize the big leaps forward that you make. And so I learned that you have to do the crappy things as well.
One thing I love about you is your confidence in your own ability and in your analysis. I don't know if you've ever listened to the podcast An Irishman Abroad.
No.
Where there's this comedian called Jarlath Regan, and he interviews Irish people who've left Ireland to make it in some field of endeavour. Mm-hmm. He talks about the tall poppy syndrome in Ireland, where, we're brought up to, don't be getting too big for your boots, and, don't you be showing off now, and all this kind of thing. And he draws the contrast between Americans and the Irish. And he says, in America, they teach you, you must love yourself. And in Ireland, they say, look at your man, he must love himself.
Yeah.
So in some ways, you're not supposed to be out there being confident and giving it Dixie and saying, this is what I believe in. But you're bucking that trend, and it's great to see somebody confident in their own abilities who's prepared to get out there and, bang the drum for themselves. And I love that. Now then, here's a softball question for you. I know what your answer is going to be, but I want to give you a chance to give it. Copy traders like to see a PI who cares about synchronization. Robert MERC, do you care about synchronization?
Absolutely. Front and center in my thought process is synchronization. Absolutely.
And that is evidenced by what recent event?
Yeah, I closed out my entire portfolio recently, and I don't expect everybody to increase their copy amount by greater than 100%. So I shut the copy down and I reopened the copy to make sure everybody was back in sync. And I tried to keep the position sizes above 1% as well, so that everybody can copy with the minimum amount. But yeah, that's definitely important to me.
Here's a few more reasonably swift questions. What sort of people should copy you and shouldn't copy you?
I would say what really frustrates me is some people will copy me for 5 or 6 days, and the vast majority of those people lose money. So in a portfolio that's up 70% in the last year with a max drawdown of 5.14%, it seems very unreasonable to only stick around for 5 days. So I think the people that shouldn't copy me are people with a short time horizon, for the simple fact that I'm buying positions, and in some cases I'll hold them for a number of years. In other cases, I'll hold them somewhere between 6, 12, 24 months, something like that. But the takeaway is I'm buying these positions over a longer time horizon, and expecting short-term gains from a portfolio that's long-term focused, it almost always results in losses. So I think that people that have a shorter time horizon should not be copying my portfolio. And I prefer that they didn't, because I've seen that probably about 80% of the people that have left after 5 or 6 days have lost money. And it's kind of frustrating to see. There are some traders on there that have a time horizon of 1 to 3 days. They're perfect for short-term trading. They're perfect.
Like a volatility trader who's in and out in a couple of days. Yeah.
Yeah, absolutely. My portfolio is more longer-term focused. And I think if somebody wants to copy my portfolio, I think you should be patient. The volatility in the portfolio is relatively muted versus maybe the NASDAQ, for argument's sake. The latest correction, we've seen 5%. The NASDAQ, I think, was down 12, 13. And then long-term, I think you should be focused 6 to 12 months. So I would encourage people to consider longer term, and I would discourage people from copying me with smaller time horizons.
Another unconnected question. Tell us about your most disastrous investment and what you learned from it.
That's an easy one. It was New Gold back in 2017. New Gold, I bought it in 2017. It had already corrected. It was at pretty much close to, I'd like to say, an all-time low. And I thought it was good value. And I was reading the management report. I was listening to the management, and they were talking about how their mine was developing really well. And I was building a lot of confidence. I increased my position. And after a while, the costs start to increase on that mine. Quarter after quarter, the cost overrun. And before I knew it, the cost overruns were drowning out the profitability long term. And the share price had already dropped. And in a short period of time, the share price had dropped like 50 or 60% on me before I got out, which was disastrous to me at the time. Even though it was in a diversified portfolio, what I learned from that, and it was pretty hard to take at the time, was that I should have got out of the position a lot sooner because management were not executing. And I'll give you an example of how I've advanced from that. So I'm watching, for argument's sake, Beyond Meat, had a position in Beyond Meat. And that experience with New Gold is starting, like, there's reminiscence of that period with Beyond Meat, where every time they come out, they're saying we have this new partnership, but they keep missing quarter after quarter their numbers. And I'm thinking they're over-promising and under-delivering, very similar to what happened in New Gold. I could be very wrong on that, but I'm not going to let myself fall into that pitfall again. So that was definitely one that was a big lesson learned.
But good to know that you're now looking out for similar warning signs when it smells the same.
Yeah, I don't really have tolerance for that. Like, here's the other part of it as well. We can close out the position and come back to it in 6 months. And if it's attractive in 6 months and the management are executing, there's probably going to be still some meat on the bone.
Okay, well, I've spent most of this conversation clearly fanboying out to Robert MERC. Permit me, if you will, to make 2 very minor and trivial criticisms. Would that be okay?
Absolutely. Absolutely. My favorite part of the podcast.
When I look at your YouTube channel and I see all these thumbnails of you looking well lit and fit and healthy and big lights reflecting your eyes, I think, well, there's a whole ton of images of him looking pretty good. But then your avatar and your background picture, you're looking unshaven, you're kind of looking sideways, like a guy in an alleyway saying, give me your phone and your wallet. And I don't understand why you would choose that picture, because you look 10 times better in your video pictures.
Yeah. To be honest, when I started YouTube, I even to this day, I don't know what I'm doing. I started back in July. I had a camera, I'll turn the camera on, I'll do whatever. And at the beginning, I had a DSLR camera, and my first videos were all blurred. The volume was completely blown out. So as of right now, one step at a time, we're about 9 months in, one step at a time is getting a little bit better. We're in focus at the moment. We've got decent lighting, which is good. And the sound has improved somewhat. I'm trying to work on the thumbnails. I started doing oil painting thumbnails because they look like the Mona Lisa, a melted Mona Lisa. But I started to do that because, they're sort of, I don't like looking at my picture. But if I look at an oil painting, it doesn't look like me. So I'll just throw that up there so yeah, I got to get better at that. I mean, I'm a bit of a rookie.
Okay, so that's one of my tips for you is to change that darkened photograph. Here's my next one, and I've tried to make this point to you on your YouTube videos, but I think it escaped your attention. Again, incredibly trivial, not important at all, but here we go. This is often how you wrap up your videos. Now, as I've said, your videos are very impressive, but they're so impressive that this little blemish stands out to me, right? You say...
I know what you're going to say.
Well, I'm going to say it anyway.
I give everyone a piece.
I'm going to say, no, not piece. You say, that's why I think this is a fantastic opportunity. Anyway, guys, I'm going to digress. Thanks for your support. Peace.
Yeah.
It's the word digress that gets me. Now, I thought I was losing my mind. I was like, this guy is super smart, knows everything. Maybe digress has multiple meanings. But dictionary.com, digress, to deviate or wander away from the main topic or purpose in speaking or writing, to depart from the principal line of argument, plot, study, etc.
Okay.
Best illustrated by way of an example, right? Say we're talking about investing and you mention fishing with a fish hour or something. And then I go off on a story about fishing as a kid with my dad in the Irish Sea in the summertime. I might then say, anyway, I digress. Let's get back to investing.
Okay. Yeah, no, I understood the meaning of it. I just like the main topic being the video, and I was like, all right, that's it. You guys go on, continue on, and then I'll finish.
You're leaving behind what you've just been talking about, but that is the central. You're leaving behind the central thing just to say goodbye. You're not leaving behind a meandering thought that has no place in the main conversation.
You know what? I think I get so many comments at this point, it's very difficult for me to catch up. So what I do is I have the app on my phone, I scroll through them. A lot of them are very similar. And did you comment on that yesterday?
Not yesterday. No, ages ago.
Someone else did. Okay, someone else did yesterday.
Oh, good. I'm not alone.
No, you're not. So it must be me. So yeah, no, I can change it. But today's video, I got to edit it a little bit later. Today's video, I left it out.
Hey, hope you're enjoying today's show. I'm sure you've subscribed already. If you're a successful copy trader, happy to share what you've learned. There's no need to have a public profile. Please get in touch. Otherwise, listener, the bigger the club, the better for you. So tell people on eToro about this show. Ask your PIs to come on. That way you will get to know them better. We build this club together. Let's talk a little bit about copy trading.
Sure.
If you were a copy trader, what would your approach be?
What would my approach be? I would be looking... See, I think that you can tell an awful lot about somebody's strategy, not by what they say in their bio, but how their portfolio is constructed and how quickly they rotate out of those positions. And so, like, I would often look at other people's strategies and I'd read their bio. When I first started, like I'm very competitive. I'm looking at everyone else. I'm like, what are they doing? How are they delivering alpha? How can I beat these guys? And so when I look at their portfolio and I look at their bio, in a lot of cases, it very much diverges. And so I always really focus on how their portfolio is constructed. And I follow my own principles: diversification, good weighting across different asset classes. Yeah, they're probably the two main things. Regarding time horizon, I don't think it really matters how long somebody actually holds an asset, as long as they're managing the risk effectively. And I think people have different preferences. Like, somebody could make a lot of money day trading. I think there's very few people that can do that, but a certain personality might work better at day trading than holding it long term, like 5 to 7 years or something like that. I've got a couple of positions in my portfolio that are 5 to 7 years, but I couldn't do it with every position. You know what I mean? So I'm not too concerned about the time horizon that people hold on to the positions, but diversification, absolutely, and weighting, how they weight their positions is important to me, because that tells me that they recognize some of the risks within their portfolio and then their time horizons at their discretion.
And how do you feel about diversifying your PIs?
I don't think you need a huge amount of diversity. I've seen some portfolios where there's like 20 or 25 PIs in a portfolio, but I think what a lot of people forget is my portfolio has 28 stocks. The next guy might have 30. The next guy might have 30. And you end up with 1,000 positions. You may as well just own the S&P 500, right? So I think you probably have, like I checked your portfolio before coming on. You've got 4 people. You've got myself and Moran, is that his name?
Karan Mohan.
Karan in stocks. The other guy's commodities, but you also have a hedge in the guy that trades volatility. So if markets start to correct a little bit, you get in inverse returns there. And I think that's perfect, where you're getting exposure to commodities. You got different diversification within equities, and you got some volatility. I think it's a perfect portfolio makeup. But I think people over diversify, and they'll allocate 2% of their portfolio to 50 different PIs, not recognizing that the vast majority of those positions overlap. And so, yeah, I mean, I don't think you need a huge amount of diversification. You just need to do a little bit of work and figure out who you're going to commit to, and then give that person time.
Yes, and it's a pretty hard time, I'd say, these days to be choosing PIs if you're not prepared to really look at what they do, because, you know, everybody looks like a genius in a bull market.
Yeah.
And if you have 40 PIs, you know, 10 of them are going to blow up.
Yeah.
Most likely, if you're just picking them without too much forethought.
Absolutely. 100%, because here's the problem that I see. If you go back to March, we went into a sell-off. And if a portfolio was down 30 to 35% throughout that sell-off, I would be concerned. I'd be concerned because they didn't react on the way down, and they got lucky on the way out because we had massive stimulus. If that stimulus didn't come and you didn't get a massive rebound thereafter, you're down 30% and you stay down 30%. And so that would definitely be a concern to me for sure. And I think that might be a little bit of an early indication as to who might perform very well if we did get a bit of a correction. How did you react within the sell-off? There's a number of portfolios that acted really well, transitioned their portfolio. And then, and the behavioral side of that, that's the risk you're taking, is the behavior from whoever's managing the copy. Because when you start to go down like that, let's say you're making money on the downside. I've seen a number of people on eToro that kept shorting the whole way thereafter and didn't pay attention to the change in the data. There's a number of really good quality portfolios that made money on the way down, or they didn't lose too much, and then they made money on the way up. And you can tell that they were following some sort of process. I've seen a number of portfolios that I would avoid that were down, let's say 30 to 35% in the crash. Obviously didn't hedge out the risk. And then out the other side of it, they got lucky. Or there are those that it sold off and continued to sell, didn't track the data. So yeah, I think there could be telltale signs there. But I do agree, because an awful lot of people that are starting on eToro, some of them may not have a lot of experience, and it's hard to know who has experience and who doesn't. So, and here's the thing. If I go back to my time in education, I would give a lot lower weighting to my education than to the experience.
Sure.
Do you know what I mean? Like, it's like what Mike Tyson says, everyone has a plan until he gets smacked in the face. And I felt like I had a plan, and I got smacked in the face in 2015. We went into August, and that's when I started focusing on macro, sort of the macro environments. The Chinese devalued the currency 4.5, 4.6%. S&P 500 drops 12% in 3 days. And I was a sitting duck back in 2015. Despite having all this education, I didn't know what to do. I sold out close to the lows, but I only gave back my profit. And that's essentially why I closed out. So, you know, experience is really undervalued in markets today. And it's hard to know who has that experience to be able to deal with it, in my view.
A critic would point out that my 2 main PIs, in whom I obviously have a lot of conviction, neither were present for the March crash.
You know, I get that as well. A lot of people push back. I mean, at the end of the day, look, I signed up on the 15th of March. I put my first trade on the 17th of March. And the 17th of March was, I think, the low of the market. So I got it pretty close to the low. And the reason why, for me anyway, I signed up in March was because family and friends asked me to join in February. And the problem was I'm already short the market and I didn't think there was any opportunities. So I was like, all right, I'm not going to do it. Market starts to sell off in March. I wasn't expecting a sell off. I was protected already, but I wasn't expecting a crash like that. And that's why I signed up in mid-March. So I think a lot of people might have signed up around that time that might have already had experience, that recognize, wait a second, the cycle's about to start again. So that's the other side of it. I mean, it really comes down to trust. You need to trust whoever you're copying at the end of the day, you know? And if you don't trust that person, you probably shouldn't be allowing them to allocate your capital. And that's the other side of it. But what I really like about what eToro do with the copy trading is, like, you guys have full control over it. If you don't like a decision that I make, get out of it. You can control that on your end. And I mean, that's the powerful thing about this. It's like, it's not like you look at The Big Short and Michael Burry closed off his fund to investors and you just kept rolling with it, even though there was redemptions. It's not the case with eToro. If you don't like it, you can get out.
Yeah, you're absolutely right. It's all about trust for me. As I explained, I came to eToro to follow one guy I already knew. Then I saw you. And through your videos, I don't need a huge track record to know that you know your stuff. I can trust you as an investor. I trust that you know what you're doing to a ridiculous extent, way beyond what I know. I'd much rather have you managing my money than me doing it. And I can also look into the whites of your eyes. When you're making your videos, you're talking to me, you're telling me your backstory, all that stuff. You're clearly a decent person. You know, you're not going to be up to any sort of skullduggery, and you're not going to throw all your investing principles out the window and invest in Neo with huge leverage or something.
Yeah.
So, you know, all the stats in the world sometimes can't replace that kind of trust.
Yeah, I appreciate that. Yeah.
Well, it's true. And I think PIs should harness that more. In fact, when I was thinking about this conversation, I was thinking, if someone came to me and said, what should I do to be a PI on eToro? I would say, take a leaf out of Robert's book, because he's doing everything right.
And, you know, the thing is, you know, a lot of people on eToro are saying, you know, that they don't get enough exposure. I've never gotten exposure on eToro. All of my growth has come from getting lucky. I got onto before they had low risk, I became first on the low risk in terms of performance. I got very lucky, got a bit of exposure there. And then through that, I bumped up onto the trending page. And so performance, obviously, you'll get highlighted that way, but also through the YouTube channel. Like, I never planned on doing a YouTube channel to become a copy trader. Like, this is all sort of serendipity. It was just something that I was like, you know what, I'm gonna set up a YouTube channel for this startup, and I'm gonna talk about investing because that's what I know. There's no production value from what I do. Anybody can do it, and I 100% agree. Like, I'd recommend everybody put their thoughts into a video and let everybody make their mind up over time. And there was a lot of skeptics for me in the initial months. Like, I remember posting a video saying, you know what, I don't like Neo. And that was my personal view. And I had the masses come after me. And I'd post another video and I'd say, look, this is turning into a little bit crazy with all the dilution, but because the share price continues to go higher, a lot of people are like, you know what, we don't care, we think you're wrong, which is fine. And then the next month there's more dilution. And then the next month there's more dilution. And that eventually long-term will have an impact. And that was my view, was like, just post what I believe to be like fact over fiction, and just stick to my principles. And people will get behind you eventually if you're right for long enough, you know. And
how many YouTube subscribers do you have now?
29,800, something like that.
And that's in a short space of time. How many months have you been doing that?
Started on the 20th of July. So, and there's another thing. A lot of people think that YouTube is oversaturated. You know, 9 months later, there's 30,000 people following the channel. So there is still opportunity there.
Absolutely. And if copy trading is here to stay, and if eToro get their way and get past the regulations and get into the States as a copy trading platform, do you think it's going to blow up there? Do you think it's going to become really, really huge?
100%.
As will your YouTube channel. And you can, in fact, I would imagine you've got big numbers of US viewers and subscribers.
About 60%, yeah.
Right. If eToro does manage to get that across the line, imagine how easy it's going to be for you to leverage those people and say, by the way, guys, you don't have to do all this after watching my videos. You can just copy me.
Yeah.
Boom.
Yeah.
J Nemesis, we're coming for you. He recognized the dangers early on, didn't he? He got your number that there's a young gunslinger in town.
Yeah.
And he's coming after the old sheriff.
I like Jay. I think Jay's a really good guy, and he's obviously very good at what he does. We've got very different styles, but he's been knocking it out of the park for many years now. But yeah, Jay said to me last year, I think I had like 8 copiers. He's like, you're going to be a black star next year, which means you need over 10 million. And I was like, I'm not sure. But anyway, he knows the platform more than I do. But certainly on YouTube, I mean, like my goal is just really to just post content and help people out. Like there's a lot of people on there that want to do it for themselves as well, and then the odd person will dip into the description and see that I'm on eToro and they'll make their way over. But anyway.
Do you think copy trading could be the future of passive retail investing?
Yes. And I think I have this vision in my head, and maybe it's just me, but I think I'm going to do a big thread and tweet it over to Yoni Asia, the CEO of eToro. But I have this idea where you could create like the eToro World Cup for popular investors. And this could be based on like not necessarily looking at top line performance, because a fund-to-fund manager focuses on risk. So you could look at like a Sorrentino ratio or Sharpe ratios, this type of stuff. You can measure it that way. And we could have a leaderboard and we can compete. But where I think it's a lot more interesting is we could use it as a benchmark. So in 2020, the average return for popular investors was 51%, according to, they're going public. I just read it on Twitter there. eToro going public, but the average return for a popular investor last year was 51%. That's the benchmark we should be chasing. And so if you do stuff like that, I think it becomes a real focal point, an exciting point. But more importantly, what I think it would do is it would actually improve the quality. Because for me, like competing with someone else, and I know all of these guys are probably the same as me, if somebody gets ahead of me, I'm up all night trying to figure out how to get back in front. And so you start to improve the risk scores, you start to improve the performance, and over time it becomes like this legacy that retail investors are actually outperforming long term. And so yeah, I do think it's the future. I really do. It gives access to people like my mom. My mom is not an accredited, well, she's not in the United States, so you don't need to be an accredited investor, but she's got some cash that she wants to put in from her salary every week. And, like you can't go up to a fund and say, hey, listen, can I put in a couple of bucks every week or every month to your fund? But you can do it on eToro, and you can find really talented people on there.
Are there areas of copy trading that you think haven't been given enough coverage or aren't discussed enough or aren't as front and center as they should be?
How could they improve it? I'm really not sure. I'm really not sure right now, to be honest. It's not something that I thought deeply about, to be honest. What are your thoughts as a copier?
Well, I clearly do think that there are underexplored areas. Otherwise, I wouldn't be doing this.
Yeah.
When I signed up for eToro, the focus I saw was all on PIs. This is how you find PIs. This is what the PIs are like. Look at all these big numbers. Woohoo! And this is how you use the platform. You press this button, you press that button. What I didn't see was this is how you can be a successful copy trader. These are the various strategies you could use. You should be employing this tactic. Most people do this. It's probably wise to avoid that. All that kind of stuff. That seems to be largely absent. So I thought, I need a place where I can talk to copy traders, or where we can come together and exchange ideas. And if I can find people with, a track record of success who know the pitfalls, then maybe we can all avoid them in the future.
Yeah, and that's a really good point, because what's really interesting about that is they have so much data. So eToro have so much data, even just based on the execution of trades, they would understand who's profitable in each copy. They'd be able to put that into some sort of deep learning system over the next couple of years. And in a couple of years, they could be able to say, based on specific portfolio types, how you could diversify into different copiers. That could be a really interesting point moving forward, to minimize the risk and reward,
My feeling is that while not all copy traders are idiots, I'm sure there's lots of very capable copy traders who, for one reason or another, have chosen this avenue, maybe in addition to doing their own investing and various other areas. There's likely a significant proportion of people who come in with a small amount of money, act the Egypt, blow it immediately, and therefore the stats perhaps that they're generating don't look good for copy trading because, there's this high attrition rate.
100%. And that goes back to what I mentioned before, that I have a bunch of people, like, I'll give you the stats. I have 400 people sign up in the last 30 days, 500 people that dropped a copy. And of the 500 people, and that's every month, that's not just 1 month, about 80% of those would stay around for maybe 5 or 6 days maximum. And almost all of them lose money. And it becomes death by 1,000 cuts, 0.5% here, 1% there. And then at the end of it, it's like really bad experience. But I think that it's that impulse. Like, I think good investing is boring. And I think an awful lot of people have these impulsives for excitement. Like they get this sort of urge for excitement. And unless you're doing 100% in a month, it's just not big enough.
Well, good stuff. I mean, so I think we're agreed on quite a lot of that. Copy trading's here to stay. It's got a great future. It's best approached as a branch of investing rather than an alternative to it. And listen, I've really enjoyed our chat today, Robert. I think you're doing, as I say, everything right. Your growth to date has been meteoric. And I think, as we said, Jay Nemesis better watch out.
You gotta get Jay. You gotta get Jay on the. You gotta get Jay on the podcast.
Put a good word in for me. I can't reach out to the dignitaries like that.
We can cause some copy trader podcast wars. Absolutely.
All right. Well, look. Thanks a lot, Robert. Really appreciate it. Best of luck to you.
Yeah. Thank you very much for having me.
There you go, listener. That was Robert MERC. If you haven't heard of him before, you soon will, because he's really going great guns. His YouTube channel is ingeniously called The Popular Investor, and I think his popularity is going to continue to soar both there and on eToro. Top man. Coming up on next week's show, we talk to Stephen Steels, who is behind the YouTube channel Moth Copy Trading. He's a young guy feeling his way through the labyrinth and is nothing if not optimistic.
In 20 years' time, I'll be a millionaire, just starting with $1,000 now and putting in $800 every year. And in 35 years, it'll be 142 million.
Sounds good to me. That's it for this episode. Until the next time we meet at Copytraders Club, I wish you many happy returns. Obviously, anything you hear on this podcast is for entertainment only, not financial advice. Do your own research. This is just generic chit-chat. We don't know your individual circumstances, etc., and so forth.